You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo, coming to you live from the Options Insider studios here in pretty scenic and sunny Chicago, Illinois. Of course, the options mecca of the known world. We produce a wide array of fine content for your listening pleasure here at the old Options Insider Radio Network. Of course, many, many archived episodes of this here program, Volatility Views, as well as Option Block and the Advisor's Option and Daily Options News Rundown. And pretty much you name it, we have a show or a category aimed at it. 13 in all, and the easiest place to check out all of that content. 9 years plus worth of content. 500 just in the Option Block alone. Well, of course, the easiest place, surf on over to the mothership, the flagship, theoptionsinsider.com. While you're there, of course, click on that Insider Radio Network tab, and your journey has begun into the depths of our radio archives. Of course, you can also find us in all of your favorite podcast providers, iTunes, TuneIn, Stitcher, soon to be Google Play, whenever they flip the switch and turn their podcast system on live. We'll be there as well. And of course, we've added yet another new wrinkle to the show over the past week or so with the addition of the live stream, which you can find over there on MixLR or Mixler, call it what you will. We tweet out the link all the time whenever we're about to go live, so follow us at Options, probably the easiest way to know exactly when we're going to go live. We're still working on the schedule, seeing which shows work for live, which ones don't. Right now, it's pretty much every Monday and Thursday at 3 p.m. Central, 4 p.m. Eastern for Option Block, and Friday at noon Central, 1 p.m. Eastern for Vol Views. That said, after I announce that schedule, I may go into a little bit of flux next week because we're heading into a big conference season here, starting with the CBOE Risk Management Conference, at which all of us on the program will pretty much be down there next week. So maybe we'll have a chance to beam in from scenic and sunny Florida. I'm not sure. We'll still work on the logistics of that. But we'll at least record some great content for you down there, even if we're not live next week. But we are live this week, and I am joined, as usual, by my corner office companion, my volatility compatriot, Mr. Russell Rhodes. Russell, welcome back to the Volatility Views program, sir.
Well, I am not in the corner office today. I'm in the back room at my house in the western suburbs. and heading out to California to speak to the Orange County Option Traders Club tomorrow morning.
What's with you and Mark both heading out to the West Coast, San Fran and Orange County, to talk to options clubs out there? Everyone trying to hedge their Silicon Valley holdings?
Exactly. They all want a collar for some reason. I don't know what that's all about.
So you don't get to talk VIX? You're just going to talk collars all day? Options 101 stuff?
They don't get me unless they let me talk about VIX.
Doesn't your business card say Dr. VIX on it somewhere?
It's going to in the near future. I was actually, speaking of academic stuff, I was actually down in Champaign yesterday afternoon and last night talking to their financial engineering group about VIX and trading volatility. And they got some awesome ideas about trading SVXY, UVXY, and VXX all against each other. So that's something that when they get back to me on the work that I left them with, we'll talk about it here as well.
That'll be fun. We always you're a pretty widely traveled fellow these days. You're going to Hong Kong. You're heading to Florida next week. You're driving down to Champaign. You're heading out to California. See, wait, you're heading to California tomorrow. Are you just flying from there straight to RMC?
No, I'm coming home for about 24 hours.
Oh, you get a day or so.
But I go straight to Tulsa from risk management.
Oh,
beautiful.
That's exciting. And that tinny voice, means we are joined late, but better late than never, by the greasy meatball himself, Mr.
There
Mark
are people
Sebastian.
that would disagree with that statement.
I'm sure there are quite a few. Maybe some even on this show.
Better never than late.
Maybe some even on this show, but I digress. Mr. Greasy Meatball, let's play the game. Where is the Greasy Meatball joining us from this week?
I am in my downtown offices on Adams and LaSalle, overlooking the derivative center of the universe, enjoying my day, enjoying the weather, and watching the market melt higher.
Melt higher, I like that. All right, since we're talking markets, let's get right into it. It's time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that music means it's time for the Volatility Review, the portion of the show we break down the week that was from a volatility trading and analysis and activity perspective. We are recording this, of course, Friday, February 26th. So all of you playing the home game want to know exactly what we're looking at right about middle of the session, a little bit after noon here, Central Time. And as Mark alluded to, a bit of a melt up on the old street today, pretty much across the board. Most of the major indices flirting with positive territory, including ye old VIX cash, with S&P up fractionally on the day, up about 1/3 of a percentage point or so. Dow, similar percentage point. The NASDAQ hovering between plus and minus, quite literally unched right now as we speak. And VIX cash heading into the weekend, taking a nice inhale, up about 1/3 of a handle or so, right around the 19.5 level. It's been an interesting week. We kind of saw earnings season kind of winding down. We had a few coming off this morning, I believe JCPenney and Hilton and a few others, but none of the really the big salient names that a lot of people like to watch as bellwethers for the market and indeed for the industry. That said, I know, Russell, you spent a lot of time watching earnings vol. Anything really catching your eye this week from an earnings vol perspective?
No, I think the excitement around this last quarter's earnings is now behind us. We do have a handful of names reporting next week, but it's finally starting to wind down. And I guess LinkedIn is the one that's going to leave its mark for the first quarter, or fourth quarter 2015, first quarter 2016 earnings season.
All right, that said, Mr. Greasy Meatball, earnings kind of winding down, not really a heck of a lot kicking off in the earnings perspective, but still a lot going on from a broad volatility perspective, VIX, SPX, whatnot. What caught your eye this week from a vol perspective, sir?
VVIX, absolutely destroyed and continues to be destroyed, and is at levels that we really haven't seen in, since last July. And, it tells me that at least in the very near term, the market thinks that we're in the calming zone. And I don't know who said VIX below 20. I want to say it was Russell, but Boy, that was dead on. We definitely softened up.
Our live chat listeners are asking if you could please stop opening your checks for 2 minutes. So hold off on the checks for at least another 45
listen,
minutes
some of these
or
checks
so.
are pretty big. You stop opening your checks. How's that sound?
Okay, then mute while you're check
no,
opening.
I'm kidding. I'm done.
I'm
officially done.
As we roll before we drive away, what live listeners we have here as we move on into Mr. Russell. We talked about the earnings. Of course, there's a lot other things going on this week, including in your realm of your soon-to-be coined Dr. VIX. Not yet, but soon once you get that PhD there. So what caught your eye in the week that was from a broad index vol perspective?
Well, I'm going to pat myself on the back a little bit. I did kind of I guesstimated that we would see VIX a little weak this past week, but I think it was kind of an easy call because there just wasn't a lot going on. We were at the end of earnings season, and we're kind of in a gap period between big economic numbers. The funny thing was yesterday, I mean, really smart kids down at Champaign, and who will all be looking for a job at the end of this year, as they continue to remind me. I was talking about the economic calendar and why VIX did what it did back in August of 2015, and then I was talking about how VIX, when there's not a lot going on in the economic calendar, we don't see as much activity. And they said, well, because that was my thinking behind this week. And they said, well, which is it? Is it when not a lot's going on? I said, well, when not a lot's going on and then we get surprised, that's when we get the 40 move. So, it was a little more treacherous this week if we'd gotten any surprises, but we just didn't have any of those known unknowns on the horizon that might have made the market move a little bit.
Speaking of known unknowns and known knowns, a few things that we do know for certain is that it was a strong time, at least according to the CFTC, for loving some vol. In fact, looking at the VIX futures data coming out of CFTC with the Commitment of Traders report, again, always a lagging indicator. It's always a few weeks behind, but they're looking at their totals, saying more long bets out there on ye old VIX from a futures perspective. And we'll talk about it in an options perspective in a little bit, but at least on a futures perspective, most since September. And we all know what a rocking and rolling period September was, coming on the heels, of course, of that big August meltdown and a lot of turbulence in the market. The Fed starting to raise their head up and say, maybe we're going to do something here, and all of that injecting a lot of volatility into the space. And yet, at least looking right now, at least from a few weeks back, again, a little bit in the rearview mirror there, but the CFTC saying a lot of people holding themselves some VIX futures right now. Speaking of VIX futures, before we get into some of the other stuff, we kind of touched on it last. Actually, we have a listener question on it, so I'll leave it till then, I think, because I was going to bring it up now, but I don't want to cut off our listener, so we'll get to it in a little bit later, talking about term structure and contango and all that fun stuff. Instead, let's turn our attention. There was an interesting article, I think it was the Bloomberg folks had it this week, kind of comparing and contrasting the VIX with the CDS level, which is kind of an interesting indicator, not one that I particularly spent a lot of time watching. I think the crux of their article was that the VIX is at the lowest level in about 2.5 years relative to what they term investment grade credit default swaps. Obviously, on the surface, there should be some correlation there because, of course, CDS kind of a bit of a measure of the end coming to pass out there in the world of listed equities and firms that have those sort of default protections. VIX, in the grand scheme, if you buy into the fair gauge metaphor, certainly on the 10,000 foot level, indicating something similar. I haven't seen a lot of data correlating these two before, so I'll have to kind of check it out. I don't know, Russell, you like to look at a lot of esoteric indicators. Do you ever sit down and compare and contrast VIX cash versus investment grade credit default swaps?
Not particularly, but this past week I got to see Larry McMillan do a presentation, and he was talking about, he actually looks at individual stock put call ratios, which is, I think, data that he keeps up with on his own, because I'm not sure where he gets it from. But he actually, he was talking about the put call ratio in the financial stocks, which I've gotten a lot of questions about financial stocks as of late, in a way to try to get an early read on what's going on there. And I asked him, if he ever combined the looking at the credits on these things. And he said, yeah, it's not his area of expertise, but it's definitely something that confirms when he's seeing, when he's seeing negative bias in the option market as well. They seem to be coincident indicators, and it's not an area of strength with me. But I do know that often things show up in the credit markets before they show up in the equity markets. In fact, one of the Nigerians told me about a month before Greece first fell apart. He said, I'm seeing this in the Greek credit default swap. So it is an area that you want to pay attention to, especially if you think we're going to move into one of those risk-on periods.
Mark, I know you mostly watch a lot of fixed income through products like TLT and stuff, but have you ever sat down and tried to divine the correlation or perhaps lack thereof between CDSs and VIX cash?
Not as much CDSs, but I do spend a lot of time looking at bond vol and how bonds are moving around, and it's pretty interesting to watch. And you can bet your bottom dollar that when bond vol starts to move, it is the dog and the VIX is the tail. It's one of the very clear ones that we know about where, just the credit guys are, because of the amount they're trading, they're much more on top of what's going on, and they're quicker to hedge. And so you see that, now sometimes credit will move and equities never do. But generally speaking, if you are a VIX trader and you're not looking at what's going on in the bond market, you're trading half blind is the way I view it.
I do want to mention, too, we're going to get to our volatility voicemail a little bit later, but those of you who have the luxury of listening live, you can start sending in those questions via the chat room. I know sometimes a lot of people like to listen, so you have to, if you want to chat and interact, you actually have to have a Mixler account. It is free, but you got to go through the steps to set it up. So if you don't want to do that, if you want to still send us questions the old-fashioned way, probably the easiest way to get to us if we want to answer it live here on the show. And we got a bunch already, but if you want to send in a few, we'll route a few live ones to the top here. Twitter, probably the easiest way to get at us, where we can see it in time and still make it for the show. A good incentive to all of you out there who are listening after the fact. Maybe if you got some time on Fridays, noon Central, 1 Eastern, you want to join us, we'd love to hear from you guys. That said, speaking of hearing from someone, I know it's Mark's favorite part of the show, and it's growing on me as well just for the intro alone. It's, of course, time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
That still brings a chuckle to my smile to my face.
It's the funniest thing ever.
I love it.
It really is.
We could have that segment multiple times throughout the show just for that transition. Sure, it's that good.
Well, I think we need to transition in and out of it going forward. Maybe we need to use the same music and say, and that was Russell's Weekly Rundown. Something like that.
I'm not averse to that.
In and out.
I'm not averse to transitioning that segment in and out. It's that good. That said, Mr. Russell, can you live up to your intro music?
Are you two done?
All right, okay. We are stamping all over your segment. I'm sorry. The prima donna has arrived.
So I'm not going to talk about weeklies in VIX. I'm going to talk about weeklies in SPX because we started trading those Wednesday weeklies this past week, and it looks like it's kind of interesting. We've got somebody that seems interested in the 1725 line, and in the 1725 line, they're looking at the puts on the Wednesday weeklies, both March 2nd which is a Wednesday, and March 9th, which is a Wednesday. I can't quite figure out why they're looking that far out of the money. Maybe that's where they could sell puts at a dime or whatever, and they're not too worried about a 225-point drop in the next couple of weeks. But I found it interesting that we are seeing some pretty good volume right off the bat in those weeklies, but it really does seem to be skewed toward the put side, which I guess you would always expect, but even more so and farther out of the money as well. So the Wednesday weeklies they're holding their own right off the bat.
That's true. I totally forgot, and all the other things going on out there, that this is the launch, the debut of the much ballyhooed Wednesday weeklies, and kind of looking at some of the numbers right now. And I have to say, on the surface, of course, I'm a fan of more products, getting more liquidity out there. On the downside, it's just going to make the nomenclature that much more obtuse for everyone. We're going to have, we're going to have
I'm
literally
looking forward to trading time spreads around this.
Yeah.
I mean, this is going to invite all sorts of types of
Monday
trades.
morning looking at the Wednesdays.
Yeah.
Absolutely.
That's going to be awesome. trade the Wednesday, Friday time spread through Tuesday and cover. I love it.
Well, this gets into something we've been talking about a lot here on the show in the past, is that, just that kind of evolution of the weekly over time. When it first started getting, they launched a while ago, and they first started really capturing the minds of a lot of people a few years back. All of a sudden, it seemed like the world collectively awoke to the fact that these were great premium selling vehicles. And so the second they're listed, bam, it was just that rush to hit the bid right out of the gate. And as a result, those things were often oversold going into Fridays and the weekends, and it was a good trade to buy them on Fridays, maybe get a little bit of a pop. You got a free weekend at the very least, and maybe you got a little pop on Monday morning as well. So now that we don't have them yet, but it's easy to intuit that eventually we're going to have that full strip of weeklies, aka dailies. And you're right, that opens up a lot of interesting time spreading. It's funny to say time spreading within a week, but that's exactly what it is, time spreading within a week. And to kind of trade off that nuances and that decay structure as it plays out over time, as well as the paper flow. And interesting to see too how the paper flow evolves if once we have this full strip, if we are still going to see that cascade of selling in the opening of all these new contracts, or if it's going to kind of maybe evolve and they'll favor one to sell more than the other and lighten up on the others. And I think it'll be interesting some nuances. I see a few papers perhaps in your future, Russell, on the evolution of weeklies and their paper flow and structure.
No, absolutely, and I'm going to jump ahead to something I know we're going to discuss at the end, but the use of these options is something I'm going to try to have as many side conversations as possible at risk management next week. That's you always want to find out how the real smart guys, and there are going to be a lot of smart guys there, how they're going about using the weeklies. I'm hoping that we go to some sort of daily format, because I think it's going to be fun to see the implied vol differences between, just before a big economic number, just after a big economic number. It's kind of, you can pinpoint it with stocks, and it's real easy to pinpoint with stocks, but sometimes it's kind of difficult to nail down with broad-based index options, and we'll have a better chance at doing that.
Yeah, it'd be interesting to see just in general, going to risk management, what kind of uptake there is on the weeklies as a whole. A lot of these guys are asset managers running big institutional funds and pension funds, et cetera. Do they even have any interest in a weekly? A lot of these guys are kind of, I hate to say it, but kind of in the set it and forget it mode. They go a little bit farther out. They're not trading intraday as much, let alone intra-week. So it'll be interesting to see if they even have any interest in the weeklies. And then, of course, if they do, how these subsequent additions of the weeklies would be added to their arsenal. I'd say it's going to be a fairly adept portfolio manager out there, or certainly a pension fund manager, who's going to have any knowledge or wherewithal of the Wednesday weeklies. But that said, I'm looking forward to discovering that for myself next week as we close out this edition of Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
We have to tweak it a little bit so that it says
he's gonna have to say that was
Russell's Weekly Rundown.
The end of Russell's Weekly Rundown.
All right, let's move on instead to a rundown of the mothership itself, the big VIX Options. Like I said, a little bit of a contrasting image there with talking with the CFTC data earlier and people loading up on the futures, at least a few weeks back. This week, not so much on the options side. Some interesting paper, if not a ton of it, going on this week. Overall, a fairly light week from an overall volume perspective. Most of the days hovering well south of the ADV, which is about 580,000 contracts right now. Most days in the 400,000 plus range, with the exception of Monday, which was a little bit higher, about 730, but still nothing lighting it off that was really crazy sizable. Talk about some sizable paper that caught our eye. This morning was interesting. Looks like a bit of a put roll. Every C puts lighting it up. That's always interesting in and of itself. This one appears to be a bit of a short put roll, and for some decent size, rolling from the March 20s all the way out to the June 20s out there in VIX land, doing it 30,000 times, paper selling those short puts. So interesting, obviously buying the near term, rolling again out in the farther term. Looks like a bit of a roll, so we'll see how that impacts perhaps some of our hot strike numbers in a little bit. Thursday later on this week, yesterday, was a couple of interesting spreads going up. Seemed like later in the day there was, I hate to call it capitulation, but a little bit of someone perhaps getting out of some upside out there in the May realm. dumping the May 30s and 32s for around 25,000 contracts each, giving those up. I think they had established those before, so apparently at least that trader saying, yeah, I don't need this aggressive May upside anymore. Maybe he's buying the hype that this is the new level for VIX, at least for the time being, certainly through May, or perhaps he had something else on. He's unwinding. Either way, giving up the ghost on that upside protection. Speaking of upside, there's some funky prints going up yesterday. I have to dig in a little bit more to see exactly what. Actually, no, that was Wednesday, but we did see the March 35s going up as well yesterday. That spread going up about 25,000 times. Also a bit of a funky, I guess you can call it three-way here. 23-29 call spread going up. Paper buying that versus also actually not versus with buying the April 19 puts. So puts coming part more of the equation Wednesday as well. We saw paper buying some March 18 puts, not many, about 10,000. It was kind of hard to find interesting size for the earlier portion of the week because there really wasn't a lot going on. I mentioned that kind of weird prints. I had to dig a little more into what was going on in this 30-35 vertical out in March because it went up, looks like paper selling it as a stupid, and then immediately later, a little bit later, going up, paper buying it. So I'll have to see what those prints were actually involved. Maybe they were out of sequence. Either way, that was a bit of a funky period going up there later in the day on Wednesday. And that was kind of it for the size paper that caught our eye. Really quick, Mark, before I get into the hot strikes. Any VIX options paper really catching your eye out there this week?
I mean, the biggest trade we saw all week was the 30-35 call spread. It was, I can confirm Barclays was the one buying it. And I'm wondering whether they bought 75,000 at kind of the top of the mark, when at the top of VIX, they paid, I want to say 36 and 37 for the 30-35 call spread. And then they also paid a quarter yesterday, and with the March timeframe, I'm trying to figure out why Barclays is doing it. Was it general hedge? What did it have something to do with their exposure to VXX and some of the other derivatives that they trade around? But that was the biggest trade. Also saw some big puts go up. Guy just did a March 1x2, the 2019 or the 2018. And paid 48 cents. He did that for some size. So, yeah, I mean, you've got a lot of people betting on both sides of the tape. You got some people stepping into hedge, and you have some people stepping into to basically play VIX to dive. And I wouldn't be shocked if we do see VIX hang in this 18, 19 range for a little bit with VVIX now heading toward 80 and like maybe even showing us a 7 handle sometime. When you see VVIX fall like that, that's a sign that, at least in the near term, we could see things relax here for a little bit.
Since you're talking VVIX, Mr. Corner Office, I see you've been busy there in the background tweeting out some interesting charts. Obviously, our listeners who are live can go over to Twitter and see that chart for themselves. Just follow Russell. If you follow any of our feeds, we can retweet it there for you. But that said, for our folks at home who are listening a little bit after the fact, Mr. Rhodes, why don't you tell us what caught your eye about this VVIX chart here?
Well, it just we're at pre August 2015 when we kind of shifted into a higher volatility environment. We're putting in post. What are we going to call that thing? A mini Asian crisis or something like that? I still haven't come up with a good name for it. That we're putting in new lows in VVIX, which kind of goes along with the theme that we just don't have anything on the horizon for about a week and a half or so. You probably see some people get in there and get some long volatility exposure next week, since we've got an employment number coming out and everybody's still debating when and if the Fed might do something. And you continue to see more concern around the financials. And if there's some concern around the big financials, that could bleed over to the SPX as well and bleed over to VIX and VVIX. And next thing you know, we're not putting in post-August lows anymore.
Yeah,
we're just in a lull period, man.
The one thing I would say, Russell, is that a big thing, and maybe VVIX is part of that, is that when we had that sell-off on Tuesday and Wednesday, I mean, VVIX hardly moved. And everybody kind of spazzed about oil, but really, oil drops in a day and a half, 8%, and the market gives away about 2%. In January, that would have been 5-6% in the S&P 500. So I think that we've seen some real changes in volatility and how it's going to act for the time being.
I do say I have to love the immediacy of this new live format. Russell tweets out a chart. We talk about it. We have people already asking questions about it. I'll feed this one real quick. Someone asking, hey, VIX currently under 83. Interesting of the timing of the low. He's guessing, is there a report out this weekend? I can't think of anything this weekend that would make no report this weekend is going to make VIX preternaturally low at this point.
No.
Well, we do get those Chinese numbers every once in a while that surprised us on Mondays, and that's something we used to not have to pay attention to too much until 5 p.m. on Sunday, but the Chinese put these economic numbers out on Saturdays, which I don't know why they do that, but I don't think there's anything like that on the near horizon. I think the biggest next known unknown is employment next Friday.
Yeah, pretty much. I hate to preempt the volatility voicemail there, but when something pops in nice and timely like that, again, that's one of the nice things about adding the live wrinkle. If you're listening after the fact and you want to tune in live, check us out over there on Mixlr. Hopefully, I'm not sure if we're going to be doing it next week, so I should curtail the plugs because we'll all be traveling hither and yon. But we'll see if we can pull something together. Certainly, the week after that, we'll be back live for you. Speaking of the exposure out there in VIX land, let's turn our attention to the strikes that are lighting it up, the current hot strikes out there in VIX land. No surprise, given that spread we were talking about earlier, that number one and number two hot strikes, the March 30s and the March 35s. The March 30s just blowing the doors off, about 470,000 contracts open there. It drops off a cliff, about 200,000 contracts to the number two strike, with about 270,000 open in the March 35s, then about 225,000 of the March 27s. So all March upside so far. Number four, the ever optimistic March 40s, still not a heck of a lot open there, only 189,000. If VIX was rocking and rolling, a lot of these strikes wouldn't even be on the top 10 chart. There's just not a lot of paper out there right now. Number five, got it down to number five to find the first puts on the chart. Number five being the March 20 puts. Talking about those a little bit earlier, some puts lighting it up this week, about 178,000 contracts open over there. Then back to March upside, in particular, the March 25s with 176,000, then the March 23s at number 7 with 159,000, March 26s, so pretty much all the March call strikes with about 154,000. And then number 9 for some more puts, the aforementioned March 18 puts with about 127,000. Rounding up the top 10 is the April finally making its way into the number 10 slot with the April 25 calls, 126,000 open of those bad boys. Total about 5.5 million contracts outstanding, about 3.9 on the calls, about 1.6 or so on the puts. Again, not a heck of a lot of paper out there to really parse yet, but the OI numbers starting to creep up a little bit to reflect all of that goodness out there. Speaking of goodness, I thought we were done parsing new studies coming out of your neck of the woods, Russell, the CBOE, at least until next week when we go down to the conference, where of course a lot of new studies will be announced and a lot of findings will be discussed. But no, you guys couldn't wait till then. You put out yet another study. These are the same people by Black and Cesato, I believe, who did that study last year about some of the effectiveness of some of these options incorporating indices. This new study discussing the efficacy of BXM, the put right, BFLY, BXMD, Combo, CMBO, love these tickers, and Condor, CNDR. Kind of finding a lot of some of the similar stuff we said with the weekly study recently on the Russell and others, that a lot of these indexes that incorporate options in some capacities, obviously these all do it in various different capacities, but they found, for example, of those indices they looked at, the puts, the weekly put, not the weekly, that's the monthly, put is the monthly, had the highest risk-adjusted returns and the highest, again, for some of that juice you're getting in the puts. The put right had that better one. I encourage you, if you're interested in the put right, by the way, we had a great episode we did a few years back with the creator of the put right index and talking about some of the interesting nuances between the put versus BXM and why you'd think on the surface they're both riding at the money S&P volatility. They'd be neck and neck, and yet there are a few nuances with the rotation, which is why put tends to outperform sometimes in some interesting ways. I encourage you, if you're interested in that, to find that one. I'll see later on in the show maybe if I can find the episode number for you. It's a fascinating conversation on some of the nuances of how these products are created and how sometimes little wrinkles in the calculation could make a lot of difference in the end product. Also found over the 10-year period they analyzed, the 10 indexes in the 29.5-year period that they analyzed, BXMD had the highest annualized returns with puts coming in right behind it, 10.13%, 10.66%. If you're not familiar with BXMD, and really, why would you be? It's not out there that much. It's the 30 Delta Buy Right Index. That can kind of give you some idea of what they're talking about there. A lot of people have issues with BXM that it writes at the money vol. They don't want to write that. They want to give themselves some upside to run with. That's why you have the stock on to begin with. So BXMD attempts to address that by giving you a little bit of room to the upside. A lot of interesting takeaways here. Lower vol, of course, lowest annualized standard deviation. Actually, the Condor Index, about 7.2%. Put's always lurking near the top. Put was about 10.1%, so substantially higher than Condor, but still, puts, it seems like a decent bet for all these indices. If you're looking at straight up, risk-adjusted returns, annualized premium harvesting, looking at things like volatility premium and drawdown, things like that, put doing fairly well in most of these studies that we're looking at. They also found some interesting nuances, less tail risk for Condor and Butterfly. A lot of different findings here. Gross premium for different versions of at the money, out of the money. I encourage you guys to check out these results of these studies for yourself. I'm going to try to get the authors on one of our programs sometime soon so we could chat with them. I was hoping to chat with them down at Risk Management, but they're not attending the conference, so we'll get them on a little bit later. That said, Mark or Russell, any takeaways on this depth of research here on a variety of indices and maybe some interesting findings that caught your eye here?
Well, of course, the absolute returns and not all of the benchmark indexes that we've got out there outperform buy and hold, but that BXMD, which we also have another index that wasn't in this study that you're talking about that came out this week. We've actually got another one coming out next week. We're doing 4 weeks in a row.
You guys are cranking over there in the research team.
I know, and I think the last one's going to be VIX oriented. I know, but that'll be we'll all be together in person to get all excited about that next week in Florida. I like BXMD. I've always liked BXY an awful lot, and I've always liked PUT an awful lot. There's a study from a while back that a couple of smart guys did, 2 studies actually, about leveraging these things, and we're gonna update those. And actually, CBOE is going to put some marketing muscle behind those 2 papers as well after risk management. And that's
nice. And I think that those.
Sebastian and I did a couple of papers about a year ago or so now, huh?
Yeah.
Because I need to
update a year
through the end of 2015. So that's when everybody else is socializing at risk management. Mark, Sebastian, and I are going to be crunching numbers over in a corner.
Yeah, and there's a lot of cool things. I personally, BXM and BXMD are interesting, but if you look at them, really, PUT and BXY are both better than, and a PUTD when that comes out, and a BXYD when that comes out, will both likely outperform the BXM, because BXM, which does outperform the market, is the simplest to explain and probably relates most to what advisors do. But when you compare it to PUT and BXY, it's not a great. It does not do as well as the other 2 indexes most of the time.
Yeah, a lot of interesting stuff. And I agree. I think BXM was kind of the first blush at that, but a lot of the people that we've talked to who may want to use it, they always say, why does it right at the money? Give me a little bit of upside. So having a few more nuances, a few more flavors, a few more varieties in the candy store for that, I think certainly could have a lot of interest. By the way, I did find The episode we were talking about earlier is Volatility Views, episode 99. So go check it out. It's called Debunking BXM versus PUT. I sat down with Jason Ungar there. That was a pretty interesting, in-depth interview. If you'd like to get into some of the nuances of these indices they're putting out there and how they're calculated and why two things as seemingly identical as BXM and PUT would have such markedly different characteristics in the marketplace, check it out. Maybe I'll even tweet a link out for some of our listeners in the chat room and others, so they could. Don't stream it now. You're listening to the show now, but we'll put it out. Maybe we'll put a link in the show notes, definitely, so people after the fact can check that one out. That's a fun one, and again, very timely given the rash of data we're seeing coming out, particularly on PUT these days. You guys at the CBOE won't stop, which I love. Gives us content for the show. Moving on to some of our other products that are exhibiting a wee bit of volatility. There's so much back and forth drama out there in crude land. We could literally do a whole show just about that. Are they going to cut? Oh, wait, they're not going to cut, but they're going to freeze. And what is the difference of the two? And it doesn't really seem to matter because we saw yet again output numbers and storage numbers, supply numbers off the charts yet again, hitting crude, and then later on crude rallying. It's so much back and forth out there in crude land that we could quite literally do maybe not an hour show, but certainly at least a half hour devoted to all the nuances of things that are going on in the land of the Texas tea. That said, looking at it this week with all the back and forth, you'd think you might see a little bit more love for some upside, especially given the talk last week, getting into some of the production cuts that may finally give a little bit of lift to crude. But yet we're not seeing that yet again playing out. Looking at the skewed numbers here across the term structure all the way out to the end of this year and beyond, and it still is clear that the order of the day is to the downside, lighten up on picking up puts down in the 25 handle and beyond, which is interesting, and again shows that structural concern, that structural fear out there in the realm of crude has not lifted. There's not really any sign yet, despite we saw earlier about people gobbling up, large numbers of VIX futures. We're not seeing that out in the crude land yet in terms of people gobbling up record numbers. I think they've just been burned too many times on the way down. They're clearly a wee bit reticent to now turn around and start saying, okay, the worm has turned, everything is good. In the realm of crude and USO volatility, both of them hovering around a 61 right now. So still elevated, but of course well off their recent highs into the 80s, about 20 handles off where it was printed not that long ago, about 10 days ago or so. Getting back down into that somewhat more reasonable range, into the mid-50 handles and down into the 40 where it was vacillating before this crazy year known as 2016 kicked off. That said, a lot of interesting things going on back and forth. Anything catching your eye out there, Russell or Mr. Greasy Meatball, I should say, in the realm of the Texas tea, the black tar?
Yeah, like I said last week, I think oil vol has topped out. And, if you look at OIV and OVX, they're starting to make their move toward 50. Doesn't mean it's a bottom in oil, but it typically means I think the panic is over. And we should expect movement in oil to slow down. And then, maybe it'll creep it lower. But this is the end of the oil panic. That is my opinion.
There you go, Mr. Russell. Anything in crude land catching your eye this week?
We're going to the teens, man.
You're just teens all vol across the board. VIX cash.
No, not the vol.
Oh, the oil. Oh, I thought you were saying the vol.
But it may get to the teens and
teens,
OVX.
Man.
It may get there, but OVX won't go to 80. I mean that's my
Yeah. Oh well. Yeah. We're done on that. We're done on that part. But I don't think the downside is done in the oil.
So you're loading up on those juicy 20 handle puts out there?
No, it's not my area of expertise.
Maybe 22 halves, getting a little bit.
That's going to be my excuse when I'm wrong.
Getting a little bit rich.
Why in the world would you listen to me on oil? I don't know anything.
Yeah,
about it.
I'll tell you, Russell. I went out to some of the back month stuff where, vol was in the 60s and 70s, and the amount of bare 1x2s you could do for credits that were relatively far apart in names in USO and WTI. I mean, it was just insane. and the premiums are still huge in those back months. I mean, at this point, I can sell regular March at 62 vol, or I can sell October and November at 50. There's still some good premiums in the far out back months.
They are setting up pretty nicely into 1x2 land, and that product, as well as in the land of the shiny stuff, GVZ, that one, not gold, but GVZ, of course, being the volatility of gold, that also being in the elevated realm, though not as high as it was not that long ago, surging north of 30 about 10 or 11 days ago, and about a couple weeks ago, actually. And now coming off the tail end of that spike of vol, hovering right around 22 for gold. Vol, in its history, 6 years or so, GVZ has only had about 9 spikes past 30. So this past week, certainly being a historic level from a vol perspective, past 2 weeks, I should say, and including, again, that was back on February 11th when it spiked up to about 31.5 or so out there. If you're looking total numbers overall, I think about 43.5 is the all-time high for GVZ. That was back in September of 2011. So obviously gold rocking and rolling a wee bit back then. Like I said, right now about 21, so about half of where it was in its record peak there. That said, it hasn't stopped people from coming out and picking up some premium, in particular to the upside. The gold skew still perhaps not as steep as it once was a few weeks back out there, when everyone and their mother seemed like they had to have gold, and they had to have gold en masse, and they had to do it for size to the upside. Now a little bit less, but still looking at the skew chart all the way out to 2016 or end of 2016 and beyond, it is serious call love. There are some puts lighting it up these days. It has given up some of the luster it had just a few weeks back, but still it is a wee bit higher. I kind of wonder what's going to take for us to see a crude skew chart look like this, and what's going to have to happen out there for people to start saying, okay, that worm has turned. Now it's going to be all calls all the time. It is very much a tale of two tapes here when you're talking about gold skew versus crude skew. I know, Mark, you like mostly GLD, not as much as our buddy Uncle Mike, but you mostly like to play in the ETFs. Anything catching your eye out there from a gold vol perspective?
Gold is overbought and vol is too expensive. Sold to you on both levels.
I didn't realize I was a size buyer of gold. I guess I am now.
Yeah, I'd be a put buyer. I would be a put spread buyer. I'd be a 1x2 buyer. I would do anything I could to short the bananas out of gold. It has no business being anywhere higher than where it is right now, and should go back toward. Gold needs to go back below 1,000 an ounce.
There you go. From Mr. Greasy Meatball's ears, or mouth, I should say, to the gold bug's ears. You said something slanderous to gold, sir, so I expect they shall be tracking you down forthwith. Speaking of tracking us down, a lot of you guys are doing just that. So let's keep on rolling into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail, the portion of the show where you guys get to join us. We've kind of been running on at the mouth, but a lot to talk about this week, but I want to make sure you guys get your love here. And speaking of which, I can see you're already having, gotta love the live stuff, don't you, Russell? You're already having a bit of back and forth on Twitter with some people who are listening and others talking about the mean reversion of what we were saying earlier about VIX being so low. We had someone write in saying, do they think it's a mean reversion play setting up with the VVIX? So that's kind of what we were saying. VVIX at that low of a level, whether it's mean reverting or not, it does perhaps foretell something afoot in the near future. So maybe an interesting time if you think the volatility of VIX is at a low to perhaps pick something up. So I can see you're a busy man, Mr. Corner Office, doing the show, responding to people on Twitter. You keep the knowledge flowing.
I'm a multitasker. So no, I just somebody chimed in and said, "You think the reversion to the mean?" And it's like, yeah, we probably are, at the lower end of trading around a mean, but I do think that what's averaged for VVIX is going to be higher than what we're used to in the past. If everybody's right and we're going into a higher volatility regime, that's gonna bleed over to VVIX as well.
Speaking of Twitter and all things volatility, we like to ask our questions of the week out here to our listeners and indeed our Twitter fans and anyone else. If we can play along as well, Facebook, what have you, people on the website. But we asked them this week, we thought earnings season kind of coming to a close. How do you guys like to trade earnings announcements using options? We gave them the following choices: long premium, short premium, I avoid earnings, or other. Really quick, we'll do a really quick guessing game. What do you think won, Mark and Russell? What are your picks for the winners of the poll?
I just saw it, so
you're cheating. All right, I will.
And I'm going to tell you I'm going to tell you that I voted for the winning one 73 times because I am a Chicagoan.
Yes. Vote early, vote often. But when I put this poll out there, I kind of thought, cynically, I thought people were going to all lean to the dark side all the time. I was hoping in my heart of hearts that they would say that they avoid earnings. That means they kind of listen to some of our shows and what we talk about on them, which is nice. And it seems like that is indeed the case. 53% so far. Still got, I think, a few days left. So if you haven't voted yet, go on over to our Twitter poll and just click on that link and let us know how you like to trade earnings. But in general, 53% saying they avoid earnings, which is encouraging. You can trade around them before and after, just that turbulent event in the middle there. Maybe for a lot of people, probably better avoided. 20% to the dark side, short premium, 17% long premium, 10% other, with some interesting esoteric vertical spreads and things that they're suggesting. That said, let's move on to some of the other questions. Oh, this is the listener question, Russell. This is right up your alley. This is the one I didn't want to step on earlier in the show. This comes from George T. We just obviously got out of an extended period of backwardation out there in VIX futures land. I don't want to put you on the spot, Russell, but you always have some interesting data you're floating around. He's asking us, what's the longest stretch of backwardation in VIX history? I thought if anyone would have that data relatively at hand, it probably would be you, Russell.
2011, right?
I wish you had given me a heads up, and I would have the
what
table
fun would
up
that
in front
be?
of me.
Yeah,
what fun
it would be 2011. I actually this came up last night in Champaign, and we were talking about this an awful lot, and I've been focusing mostly just because of the relationship to the ETNs. What's going on with the front month versus the second month implied volatility or second month futures contracts. And Mark Sebastian was absolutely correct. It was back in 2011, and it really was just almost a matter of when we roll. You've kind of got a coin flip for a short period of time as to whether or not we might end up ending that streak, because we had one streak that ended December of 2008, and then another one that ended March of 2009, and I think there was a small break between the two because of the holidays. So that 2011 one is the longest one, but if you say maybe periods where we're 90% or 95% of the time we're in backwardation, the 2008-2009 period would be a little bit longer. The one that we just ended in the middle of February was the fourth longest streak at 30 days.
Nice.
There you go. I somehow knew you would have that at hand. And we do give you a fair bit of warning. We do send out the notes. We give you at least half an hour, so you have some time to collect yourself before we unleash the unwashed masses upon you. Speaking of which, you can get at us all the normal ways, Twitter, Facebook, our website. Now, of course, with the live chat and other places like that, we're looking to expand the ways you guys can reach out to us. Meanwhile, we have to keep on rolling. We've been gassing on. We'll save some more time for listeners next week. I promise you, as we move on into our crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. This is indeed the portion of the show where we attempt to divine what those ever fickle volatility gods hold in store for the coming week. I'm looking at our tallies from last week. I was pretty much in the 21.5, 22 range. Mark was on the high end, 24.5, and Russell wins it with his 2016 lows of the 19 range, which we actually did hit. We did break through our 2016 low, which I believe was around 19.3 or somewhere in that range. So Russell wins it by the Price is Right rules and by the regular rules as well. So we'll give you pride of place. It's a dubious honor, I know, when you win to get to go first, but that's the prize you win, sir. So go for it.
I can't pull a George Costanza and just say I'm out of here.
Just look busy and be angry.
Because I don't think I'm ever gonna nail it like I did this past week.
You did pretty much kick it out of the park on that one.
And there's a lot of luck around a 1 week projection like that, so I'm not sitting here bragging on it. And now I've got to try again to
now you're setting yourself up. You're in dangerous territory.
So I'm going to say that we're going to peak out at about 24.98 on Friday next week, based on a very uncertain employment number.
24.98.
Not 25.
Wow.
No,
I like that.
No, 24.98.
I'm going to put you down for that. I'm going to put you down for 24.98. That might be my favorite.
That's the high next week. I am pulling a Costanza.
That might be my favorite prediction we've ever had here on the Crystal Ball, 24.98. Mark, do you have a similar precise level of volatility you're looking for?
I'm actually going to go 1802. So I think that we've got – I think you'll see the peak on Wednesday, and then people will dump premium into on Thursday and Friday into the employment report. So I think you may see a high as 24.98, although I think it'll be somewhere closer to maybe 22, 23, 22-ish on Wednesday. And then Thursday, people are going to step in and just annihilate volatility. And then it will their chickens will come to roost on Friday. And at the time of our next recording, the VIX will be trading 1801, down 88 cents. 0.88%.
1801. I love that. So I can go the Price is Right way and say $1 or one handle in that sense.
My Thursday settle is 1889.
I like that. Of course, you're right. These are always the most fun weeks with the non-farms because the script is going to change completely from Thursday into Friday morning, and then even by the time we start recording, it's going to have script. The flip will have script, or the script will have flipped. Easy for me to say. Yet again, we could be where Russell is in the morning and where you are in the afternoon, very easily coming off a number like that. So you guys are strangling here with 25 and 18. I'm gonna what are we at? About 19.7 right now. So I'm gonna go with I think we'll be elevated going into the morning. The question is how much we come off. And I'm going to say right about, since you guys are all going to the decimal, I'll do one handle north. I'll go 19.01. That way we'll have nice, precise predictions, and we'll see when it's 32 next week or 15, and we're all horribly wrong. Meanwhile, it's all the time we have for this episode of Volatility Views. But before we go, really quickly, let me check back in with each of my cohorts. Mr. Greasy Meatball, I know you got to run, so what's cooking in the land of Carmen Line and indeed the pit?
We're just trading away, enjoying things, and Option Pit, read our blog. We've been talking about VVIX all week, and its effect. We've also talked about bond vol. So if you're interested in volatility, we're going to try and pull up some sort of thing that we're seeing in the vol space just about every day. So our blog, optionpit.com/blog, should be a go-to destination for you vol traders every day.
There you go, listeners. Check it out. And Mr. Corner Office, in addition to working on various degrees and whatnot, what else is cooking in your neck of the woods, sir?
Just getting ready for risk management with you two guys. I'm going to be handling a good portion of the blogging and social media activity. We just about always have some sort of new product announcement that goes along with risk management, and if we do, it'll come out Tuesday morning when Ed Provo, who's the president, gives his welcome address. So we'll be, and they don't let me know until the very moment they hand me a press release and they say, here's what's going on. So I don't even know. But I know from history that that's a good chance of what may happen.
So you're saying the impending launch of Weekly Tuesdays is coming?
I didn't say that.
Tuesday Weekly.
don't even.
That's going to get really confusing.
Because I don't want somebody to hear like 2 seconds of that. And next thing you know, there's a Bloomberg story around it.
That's true. Bloomberg,
you guys
run
don't
with
want to
it.
have me on anymore because I'm not at CBOE.
Well, then you're free to just talk whatever you want. Then you're going to go crazy. But of course, he is joking. But we are indeed going to be doing a lot of fun stuff from the CBOE Risk Management Conference next week. If you guys haven't booked it, surf on over to CBOERMC.com and check out the agenda and stuff for yourself. If you're going to be in Florida or if you're in that region right now anyway, on the West Coast there, it might be worth swinging by. It's kind of the only game in town when it comes to this sort of esoteric deep dive into all things volatility and VIX. And we're still figuring out what our content flow is going to be from that show. I'm going to be sitting down with a few people, do some interesting chats and interviews. I may, if I'm crazy, I may even unleash the greasy meatball to do a few interviews on his own, which is without me watching over him, which is always a scary prospect. But I may do that, and who knows what we'll get. So look forward to that as well. Stay tuned to this feed as well as to our network feed. We'll try to put some stuff up during the week there as well. I'm not sure about the live, but we'll be able to get it going. It obviously depends on the connectivity from the conference center and what we have available down there. So we'll try to maybe get some live stuff out there. Maybe I'll even try to live stream some of the interviews, but we never know. No guarantees until we get down there and see the setup and how it all works. But stay tuned to this feed, to our network feed, to our main interviews feed, for all that stuff coming out, our conference feed as well, and also to our Twitter feed. I always like to make pull a few nuggets from the conference to put out during the day, so stay tuned to Ad Options if you're not doing that as well. And of course, a big thanks to our partners on this program, of course, Russell Investments. Surf on over to russell.com, check out the indexes and all the other products they have to work with, RVX, etc. A lot of cool new ones coming down the pike, a lot of them actually in partnership with you guys over there at CBOE, Mr. Russell, and of course our friends over there at CBOE Live Vol. If you're wondering, hey, where the heck do they get all this cool data that they're talking about on the show? A lot of it we pull. In fact, I have Live Vol running right now. I have it running throughout the show all the time. So if you're not checking it out, you get a free trial. Might as well do it. Go head on over to livevol.com, click on the get the free trial, and kick the tires for yourself. Tell them we sent you over at VolView, so I'd like to hear that. And on behalf of the Corner Office Fellow and the Greasy Meatball, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for increasingly tuning in live. Don't worry, we'll get a nice schedule worked out for you so you know exactly when to tune in. And we'll see you next time for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.